I think that overall the technology sector is still going to be strong, but clearly this is a warning shot across the bow that maybe things aren't going to be as perfect as investors had thought.
Mike made a lot of good points about how this is really just pushing the stock back. What'd you say, a few weeks at this point?
Well, no, back to about May. So, we've lost about 2.5 months worth of gains. And so it's interesting how it seemed like, this kind of no-risk trade. It was a combination of momentum plus the best businesses anybody could find, plus the biggest stocks in the index. I mean, it all worked together to have people crowding in this one area. So the question today, it's almost too cute. We get a little bit of a truce on the old economy tariff fears, right, and it seems like it could create this rotation.
Well, I think some investors have started to think that growth was the new safety. You really couldn't go wrong here. And so this is just a knowledge that things don't always go according to plan.
Where have you been when it comes to FANG stocks, and are you changing your opinions based on what you've heard?
I can't really talk about individual stocks, but overall, we don't make big bets at the sector level. It's just not the nature of the kind of quantitative approach that QMA takes. Mm-hmm. I do have some positions in those stocks, but it's not a big part of our portfolio. And quants as general, including us, tend to be a little bit more tilted to value as well as kind of a combination of growth and quality.
Let me ask you one. I know you can't talk about Facebook specifically, but let me try in a different way, which was that Nancy made an interesting comment of this idea that there's going to be a rotation in terms of the type of investor that's thinking about Facebook, the idea of this growth investor being frustrated and a value investor perhaps either stepping in or being the larger majority of the group. Does that make sense to you?
Well, value as a style has been out of favor now for a couple of years, and these stocks, the FANG stocks and others, have done extremely well. And you might see a little bit of a shift in the
mix,
ownership of who owns these stocks. If they do fall back in price to the point where they actually look attractive based on more traditional metrics like price-earnings ratio and price-to-book ratio.
But can you look? By the way, can you look at a stock like this and actually even get to those numbers?
Well, it depends. Not all the FANG stocks are created equal when it comes to their valuation metrics, but people will be looking at them a little bit differently, I think, today.
Ed, is this a time for a shift in leadership, though? As Mike points out, are you going to see people looking at that and saying, look, we want to be in these names that have gotten crushed by all the trade concerns?
Well, I mean, there's a lot of different names that have been crushed over the last several days, some of which are very traditional value names and some are traditional growth names. So I think you learn a lot during earnings season. And I think overall the earnings picture has been terrific, but there are, again, some warning signs that things aren't necessarily perfect.
But it sounds as if you're saying, hold off. This is not a time for a major shift just yet. These are early signals in both of these situations?
It's one day from one report. I think if you look at the overall picture, it's still pretty positive, both for the tech stocks overall as well as for the market overall.
But I'm also saying, just in terms of trade, you think it's too soon for people to say, whew, trade concerns are out the window?
Oh, absolutely. So, there's a difference between risk and uncertainty. Risk is kind of, you know what the range of possibilities are. With uncertainty, you don't really know exactly what the range of possibilities are or the odds of different outcomes. And I think trade falls into that category.
Hey, RJ, the story with the bond market this week has been what's happened to Treasury prices. It's been unbelievable watching when we think the Bank of Japan might start to roll back some of its stimulus, watching what's happened to those prices. How does that play out in the municipal bond market?
Well, muni bonds are bonds, and as Treasury yields have risen, so have munis. Munis have outperformed all year, and they continue to have a firmer tone, mildly outperforming even in the recent backup in rates led by Treasuries. U.S. Treasuries, if it were focused on just domestic factors, would probably be even higher in yield. The BOJ, the ECB, very low rates, negative rates, have held U.S. yields down for a while. Just a simple whiff of a change from the Bank of Japan caused a re-steepening of the curve temporarily, and U.S. yields to head higher. So a lot of eyes here in the United States are looking at central banks in Europe and Japan this week for sure.
But are you looking at municipal bonds as a place you want to be? You think the yields will continue to rise there? Are you on the side that's betting that Treasury yields are going to push above 3% and then keep going up?
Yeah, and I've pointed this out other times I've been on your show. We expect the 10-year Treasury to end this year a good bit above 3. Call it 3 1/4 just to give us a direction and a magnitude. Muni bonds are apt to incrementally outperform, but as the yields have risen 50, 60 basis points on the year in Treasuries, fixed income returns are pretty muted. Munis are still incrementally positive. The supply of munis has plummeted pretty sharply relative to half-year points in prior years in reaction to the tax bill, and the demand is still strong. Supply and demand matter everywhere, and munis have benefited from that. We still think that that will hold true, but it'll be muted returns, not roads to riches.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.